Hello, this is Josh Belk with the Belk on Business podcast. On today's podcast, we're actually going to show you a recording we did a couple weeks ago with the Active Turnkey podcast with the Olson Group. Spent about 45 minutes or so. The video that we're putting out, the audio is edited. If you want to see the full podcast, you can go to their Active Turnkey podcast platform and see it. We edited it down to about 45 minutes, and especially if you're a real estate investor, but I think many business owners will find this particular podcast that we recorded helpful. Talk a lot about structure of a business as well as taxation, especially as it relates to real estate investors, but we get into a lot of talking about active and passive as it relates to taxation. Hope this particular podcast brings you value. If it does, please, I would encourage you to consider subscribing to the Belk on Business podcast. Have a wonderful day.
So, Tom, what are some of the questions that investors are asking right away about?
Well, Josh is my accountant. So first of all, Josh is my accountant. Mm-hmm. He's not on the show to try to drum up business. Mm. He might get business, but at the end of the day, he's got too much business, and he doesn't need any more business. A couple years ago, I'd have Josh on and be like, everybody, you guys need to use Josh. I used to probably send people text messages every week. Who do you use for your account? I would tell everybody. I have stopped telling people who I use now because Josh is so busy that sometimes he doesn't even get back to our stuff really fast. But he is honestly he's becoming a national speaker, and he's really becoming well known in the real estate space, because to be a real estate accountant, you kind of have to be niche. You can't just say I'm an accountant and I do real estate, because there's so many things that are going on in the real estate world that you have to understand. You have to understand. I mean, it's so funny. Most people don't even understand depreciation. People don't understand some of the real basics. So I think we haven't had Josh on this podcast yet. So we're going to try to go over some of those real basic things today.
And it's interesting because, investors, they do their homework. So when I get on the phone for the first call, they're studying deals. They're evaluating what's important to them. They're going through all that stuff. And then usually later is we're like, oh yeah, there's this tax stuff I got to think about. And so how do I create an LLC? And we'll get into all these different things. But these are things that come up, and it's usually well later after they've either started investing or they're in the process of getting going. So it's interesting how that works, for sure.
Absolutely. So, I guess you kind of already brought it up at the very beginning when you're buying a property. And I guess this isn't really tax, right, Josh? Is company set up tax? It could go into tax. So why don't you just start there? So the type of entity that you want to have, just let investors know what types can you have, what types do you normally recommend, and what types do you normally see, and what are the benefits and features of each different entity?
Sure. Whether, of course, scriptural principle and a multitude of counselors there is safety or security. And one, I think it's extremely important when anyone gets into any sort of a venture. In this case here, we're talking about somebody who want to maybe diversify what they do, maybe add real estate into their portfolio. They would reach out to a company like yours when they're looking to purchase a property, and of course that would be one of the people they would of course want to lean on your advice and expertise. But any person wanting to go out and start something, generally they would want to have a conversation, generally with their attorney and also with their accountant, and there can be a lot of overlap, both with on the legal side and on the tax side as well. And so in our office, generally we can we'll try to walk clients through the front end and then give them some direction. Sometimes they would use us for the entity setup, and sometimes they would go to their attorney, depending on where they're at and what they're looking to do, depending on what state they're in, and what they have going on, not just within the business, but also as part of the overall estate planning tools that they may utilize, a trust or something to that effect. So when you're getting into something, when we talk about the legal side, primarily we're more concerned about asset protection when we talk about the legal side than we are the tax side.
Right.
So those decisions that get made. So, for example, for somebody who's going out and buying their first turnkey property, for example, if they were to call my office, the first thing I would suggest that they do would be to set up at least a single member LLC to place that property in for asset protection. It doesn't do anything for you for tax. It's going to be taxed the same way, regardless. But to have that asset, to have that protection, more for what is their bread and butter. For example, if you might have maybe a doctor listening to the podcast today, or somebody who's another type of a professional that they're not a real estate professional. So they're getting into their first property. They want to, they may have read, Think and Grow Rich or something like that, and they've got these, seeds planted in. I need to go and diversify into real estate, and it's what wealthy people do. And so, how do they go about doing this? And if they were to contact me, I would suggest set up at minimum a single member LLC. you're going to place his property in. And then you go through the conversation in regards to insurance and some of this other thing. But it gives you that asset protection side, and then making sure that it's set up properly and that you're following the rules that relates to what's required with the LLC setup.
So when you talk about that, that's very basic. There are lots of other entities that you can obviously own property in, right? So you can own property in an S corp, correct?
You can. It's generally recommended that you never have rentals in an S corp solely, but you can. Yes, there's nothing that prohibits it.
So you said that. Now that's kind of where I was going with this. You can own it in an S corp, but generally for rentals, for an investment, if you're going to hold the property for a long period of time, it is more advantageous to go with the LLC, the single member LLC, or maybe if it's a partnership or whatever. Either way, why is it more advantageous?
Okay, so whether we're talking a single member LLC, which is if it's just you're owning it, it's a multi-member LLC, which at that point by default would be taxed as a partnership. So maybe you're bringing somebody else in on the deal, maybe a husband and wife if you're in a state to where that may make sense. Where that would be structured as a partnership. It's still going to give you the asset protection, and then the taxation is going to be a little bit different. So a single member LLC is going to be on your individual tax return. A multi-member LLC is going to be taxed as a partnership. So it will have its own separate tax return. But regardless which direction you go on that end, whether it's a single member or multi-member LLC, whether it's taxed as what the IRS says a disregarded entity, or a partnership, multi-member LLC. In both those situations, there are no tax issues that you would run into there. The taxation can be the same. The problem is when you have an LLC taxed as an S corp or an S corp, and you place a passive real estate investments into an S corp, the IRS wants for S corp owners to draw a salary. So what you end up having to do is transition some of your passive income and turn it into active income. So then when you start, you have all the payroll compliance piece as well as the additional payroll taxes that come into play. So it is not a wise decision when it comes to taxation to have rental properties in an LLC tax as an S
that
corp.
passive income that we don't have to normally pay our Social Security, our FICA, or all the other stuff on it, you could end up having to pay that upwards to what, 14%?
Right, so you end up with the 15% SECA tax or FICA tax in the case of payroll, plus your federal unemployment, your state unemployment, and just the cost of the compliance cost to have the payroll processed and have those tax forms filed.
Absolutely. So that's why like LLC versus S corp, according to the accountant, not just according to me, is normally better. So can you also? So what about a C corp?
So C corp makes sense, and I think for a lot of individuals or entrepreneurs, when they begin to build out their essentially if they have multiple businesses, different types of income streams, it may make sense to put it into a C corp. And we can really get into the weeds on this, but for most people, it's not going to make sense. But there are situations where it may make sense.
Now, most of our buyers, when they're buying, they're using conventional financing, and so they have to have the entity in their name initially to purchase. And
the house in their name, not
the house.
an intent.
Excuse
right,
me, yes, the house, right. And so typically, they're concerned about right away getting it in the LLC. What would you recommend in those situations in this type of scenario when it's in their initial name, but then the LLC is obviously in their LLC's name?
Right. Most of the time, lenders don't have an issue if you quit claim it into the LLC, provided you're a personal guarantee on it. However, lenders can execute a due on sale clause that's usually within mortgage contracts when you try to make that transition. Most of the time, if you're transparent with the lender on the front end, and you're working with a title company, you let them know this is a single member LLC. It's going to be a personal guarantee. Most of your lenders out there, if they're used to dealing with real estate as an investment, know how to work through that and kind of get beyond. And we deal with lenders day in and day out. And ideally, if you literally close the property right into the LLC, it's placed in the LLC, and you're the personal guarantee on the loan, then you're generally not going to have any issues. To try to close it in your name and then move it later on, and usually lenders will not execute the due on sale clause. However, it is a tool in their toolbox that they can use at some point if there end up becoming issues with the loan, for example.
Sure, down the road. So let's get into what are the real tax advantaged potential ways to be able to own real estate. And so the only other two that I know of, and there might be more, obviously you can own a fund, you can do other little really more complex things that we're not going to get into today, but you can put a house into a land trust, which there's really absolutely no tax advantage at that point. It's really just an extra entity, and it's whoever the beneficiary of that is going to be taxed in that way, correct?
Right. So land trusts are an anonymity tool, primarily. So when somebody goes through and they try to find out what you own, for example, it would never pop up. So the property, if you're buying a property at 123 Johnson Street, it says 123 Johnson Land Trust, whatever the case may be. They don't know who owns it. They don't know who the grantor or the beneficiary is. And we do have a lot of clients that use this. Now, these grantor-based trusts are handled differently in different states. But most of the time, you can place it right into the trust. The land trust documents, at least in Indiana and other states, you have to look at your own state rules. Those land trusts are not recorded. So an attorney doesn't know who owns the property. The public doesn't know who owns the property. They just see the land trust. And then, so that is a way that you can own the property, right? And provides anonymity. That it's not asset protection in its purest form, but it's a type of a way to kind of protect yourself. And then, and also, it is a way that you can transfer property from one entity to another, or from a grantor to a separate beneficiary, and that can get really complex. But it is
by simply just changing the beneficiary.
By simply changing the beneficiary, it doesn't change necessarily the taxation.
Right. So the taxation all goes to whoever the beneficiary is. So if the beneficiary is an LLC, it's going to go right as an LLC. If it's an S corp, well, you might run into the same problems that we talked to as an S corp. If it's an individual, it's going to be just like an individual.
Right.
So, as a novice, like for me on this side, I don't know as much about this side of the game here. So, if I own the property, say it's in my name or an LLC, and I want to move it into a trust for that camouflage, does it appear as a sale?
No.
So how I guess if someone's word was to
the
follow
the title will
chain,
show as a transfer of title.
It shows a transfer of title, but it's not considered a sale.
Correct.
Okay. Well, I guess in my mind, like if someone were to try to follow along to find the owner,
they could.
Would it appear to them that somebody else owns it once it moves from either my name or the LLC to the trust?
Well, ideally, you want to close it into the land trust, and simply because when somebody goes and does a lookup, they'll see that XYZ properties purchases, and then it was transferred a few days later into this land trust.
Yeah.
So then they kind of look and say, okay, well, we saw who owned it before. In all probability, they own it. So ideally, you would want to close it directly into the land trust. And once again, if you're utilizing a lender, and there are many of them out there that's familiar with real estate investing, they work heavily with real estate investors. They're going to understand it, and they're going to be able to help you and walk you through that process.
Interesting.
So that didn't offer us any tax at all. It's really just a whole legal anonymity thing, but there is a way you can buy a property in an IRA. So maybe we'll run through just real quickly, high level, buying a property in an IRA. Like, how can that be beneficial for you?
Okay, so a lot of people, when they think about their retirement, most people think by default, they think of, okay, I'm going to invest in a mutual fund. I'm going to buy stock. I'm going to do those types of things. And there are people out there that don't realize that you can do what they call self-directing your IRA funds. So essentially, if you have it into Vanguard, or I probably shouldn't name names, but you guys kind of get the point. So you have it in kind of one of these traditional types of places that most people think that they place their retirement funds. That you can actually take those funds and basically roll that money into or with a custodian, what's called a custodian. You cannot self-direct generally on your own. You generally have to have a custodian. Okay, and then we can get into checkbook, IRA, and those types of things, which is probably outside the scope of this. But generally, if you're buying passive real estate, you're not going to want to get into trying to figure all this out on your own. Generally, you'll want to contact a custodian, and then set up and you can do this online with most of them. You set up a self-directed account with them, and it needs to be a lifetime type of an account. So it's a 401k, if it's a SEP, whatever it is, and you're going to roll it into a self-directed. So say, for example, let's use numbers here. So say, for example, you have $100,000 currently in your IRA, your 401k, and your SEP, whatever it may be. You can choose to self-direct it. So you would contact the custodian, you set up this account, and then you would roll the funds, that $100,000, out of your Vanguard account, wherever it may be, and you simply roll it into or transfer it into the custodian's account. Okay, now you own the account. So generally, it would be the name of the IRA company, FBO, or for the benefit of, and then it would have your name, IRA. And then at that point, you could take that $100,000 and you can purchase a property with it. And now you can't be going and buying fix and flips and doing the work yourself and those types of things. So if we're talking about an active turnkey, like we are in this particular podcast, you can go through and buy and purchase a turnkey property that is you're going to place a tenant in. There's going to be a property manager on it, just like you would outside of your IRA. But then what ends up happening is you take that $100,000 and you purchase this property. There's a tenant in it. The IRA at that point, month over month, would receive that check or that money coming in back into the IRA. So essentially, at that point, your IRA would grow. So your IRA holds and would hold title to the property, and then it grows by the rents that it's received that it receives every month. Beyond that, you can, and some people are a little bit scared of this, Tom, as you know. People get a little bit nervous that, $100,000, especially in this market, isn't going to buy me a turnkey property. I've identified one for $180,000. I only have $100,000. You can get a loan for the other $80,000, and then it becomes leveraged, and then you become subject to a little bit of what's called unrelated business income tax. And you would just pay a little bit of tax basically on the income that you receive, based on the percentage that is leveraged.
Yeah, and I think the other thing that people get hung up on is if you own a property in an IRA, you don't get to take advantage of the other tax advantages outside of an IRA, like depreciation, so to speak. Mm-hmm. However, if you are using leverage, you actually do get to take advantage of it for the portion of it that's leveraged. Mm-hmm. So it does still reduce your taxable UBIT or unrelated business income tax. But at the end of the day, we talked about this before the podcast even, is a lot of people are afraid of UBIT. They think it's this big extra tax. It's really not that much. When you really run the numbers, it's always less than 10%. Every time that I've ever seen somebody do an actual thing with property in an IRA, they've always found out it's way less than 10% of tax. So that's not 10% of the money that's in there. It's 10% of the tax that you would have ended up paying. It's really a very small amount of money when you consider all those things. Now you do have to put 40% down. There are only specific lenders that will do these types of loans, and that could be a different podcast. We talk a little bit more about maybe specific. We have a custodian on or something that will talk about IRAs. But I did just want to let everybody know that there is other tax advantages that you can, or advantages of a way to actually purchase and what entities to actually have properties in. Make sense?
Oh yeah, I'm ready to write a book. I'm just kidding.
Jared's ready?
No, just kidding. So Josh, what are some mistakes you see investors making? Just out the gate, what are some things you see? Again, particularly within the rental side of things. Do you see them where is that the land for you? Where you notice that?
Well, I think primarily it's not having the conversation on the front end with the people you need to have the conversation with. Mm-hmm. So many times we see clients, not just in real estate, but in across the board, that they'll reach out to us or their accountant or their attorney even after they've already been in business. When we talk about tax, and we'll silo this to tax, there are a lot of things that can be done in December that cannot be done in January every year. Mm-hmm. So to make sure that that you're not going out there, you heard about this, maybe you're in a mastermind, maybe you heard about this on TV, maybe you read this in a book, I can do this.
Or at the Active Turnkey podcast.
Yeah, or at the Active I can do this, and you get a light bulb on, I can see a way that I can amass my wealth by using this vehicle, by using this type of investment.
I annoy Josh every time I go out of town because I'm always like, can I do this?
Yeah.
Well, and it happens. I mean, if you were to look at my phone, people go and they hear things, and I'm glad they do. I like that there's education platforms like this one that can get this information out there. But a lot of times you're hearing something in a room, or you're hearing something, you read something somewhere, but it may not necessarily be directly applicable to you.
Sure.
So to make sure you're having that conversation, that you're setting up your LLC before you buy the property, that you're going through and you're having that conversation with your accountant to make sure that it's structured in a way as it fits, as it relates to your taxation. So you don't go through and throw a bunch of money after something that isn't going to give you the most impact as it relates to either tax minimization or increasing your wealth.
Awesome. Love it. So the only other thing that I know, Jared, that's really tax related that I know for sure we want to get in this podcast, and maybe you have more questions, and Josh, maybe you have, I would like to get us a little bit of an update 2021 if there's some kind of update on things that are going. But I think the other thing that I think I I think I understand for the most part, but even being owning rentals for over 20 years, like I still feel like I have questions on, and that is depreciation. Understanding depreciation. Why does the government even give it to us? And then I think I know the reason why, but like what advantages are there really in real estate? And I actually feel like it's kind of like one of those hidden advantages that most people don't understand. But the ones that do understand, and for instance, I have one of our investors, and he told me for the first 2 or 3 years that he owned rental properties with us, he had about 20 properties with us, it wiped out almost all of his active income. And this is a dentist making like $300,000-$400,000 a year. It's a serious amount of tax savings, or deferment really is kind of more of the word. That is kind of a hidden benefit. It's one of those I call it one of the 5 cash flow drivers in your actual property. People only look at the cash flow, how much money you make at the end of the month. But like the equity pay down that you're paying every month and the depreciation are one of those kind of hidden things that you don't really realize until at the end. So Josh, can you do your best to explain depreciation? How does it work? And then why does the government give it to us? And then how does it, kind of end up, kind of all coming back full circle when you go and sell a property?
Okay.
And then maybe we can get into 1031s if that kind of like leads into that.
Yeah, so there's like 3 or 4 things there, and it can be a very, and I could I'm sitting here. I could sit here and ramble on about this for quite a while. But let me try to kind of quickly run through this. So when we talk about taxation in general, we have to realize that the taxes are there to basically do one of 2 things. Okay, so first of all, and I'm going to try to keep this as apolitical as I possibly can.
They're not there to take money out of our pocket?
So yeah,
okay,
sometimes I don't want to.
I went political. He said no political. I'm going to go there.
So because both sides of the aisle have and one side is a lot of crony capitalism. The other one is kind of this whole kind of redistribution of wealth, kind of that goes behind it. So, but primarily the taxation is there, or the tax strategies are there to get us to act in a certain way. So when we talk about special types of depreciation, which I'll get into here in a moment, is to get us as business owners, as investors, to act in a certain way.
I mean, I think that's the best way to like explain it. I really do. But like, I always question that. I'm like, do they really want me to do this? And then when I do it, like then like as an investor, we all get criticized because we're crony capitalists, right?
Well, a lot of times you get criticized.
We're just literally taking advantage of the system that has been set up.
Yeah. And we have clients that literally, they make millions of dollars a year and they pay no income tax.
You got it.
And it can be done.
A lot of it happens right here.
Yeah. And so, and it's one of those things that but you have the thing is when you're saying they're paying no income tax, I mean, a lot of them.
It's deferred.
Well, let me go beyond
tax.
that. I think it's extremely important that we point this out. I mean, Jared, you own businesses. Tom, you own businesses. I do as well, beyond just the accounting firm. And one thing that all of our businesses do is we hire employees. You don't realize the amount of tax that we pay in payroll taxes, property taxes, all these other types of taxes that we pay. And so income tax is just one of those taxes that we happen to pay. So it's not like you're not paying any tax. It's just that and a lot of those taxes that we pay are for the benefit of our employees.
You got it.
The matching of the FICA taxes that come out of it doesn't come out of the employee's paycheck. It comes out of the bottom line of the company. Unemployment tax, which has been a big one over the last year. Employees appreciate the fact that we pay that. So in case they end up having to be let go, whatever the case may be. So I don't want to go down that rabbit hole, but when we talk about ordinary income taxation, let's talk about silo it to real estate. In order for a individual who invests in real estate to take the most advantage as it relates to depreciation, is they have to be considered a real estate professional. Now there are 4 different ways you can be considered a real estate professional. I don't want to go down this rabbit hole either. But bottom line is, and I'll use a 750-hour rule. So you have to materially participate in the real estate activity. So this can be development, management, construction, whatever the case, hands-on, whatever the case may be, for 750 hours a year, and you need to keep some sort of contemporaneous records of it. So kind of keep a log that can include, going out identifying a property, doing these types of things. If you meet that 750 hours, you can do the math, how many hours is that a week, that type of thing. But if you do indeed hit the 750 hours, then at that point your losses do not have a ceiling on them. If you're under it, depending on your income level, it's going to be capped at $25,000. Now you're going to take all of your passive real estate activity and combine it. So if you have a $30,000 loss on one property, you can offset it against the $30,000. It doesn't matter of the 750-hour rule. Okay.
So that's zero.
Right. So it wipes itself out. But if you're going to take the maximum benefit when it comes to depreciation, you want to be considered a real estate professional. Okay, and getting into whether or not you do apply, you want to have that conversation with your accountant, and then making sure that you fully understand the 4 different ways and maybe structure your particular, the way that you operate in a way that you would meet one of those criteria. Okay, and so once you're there, then at that point, you can take massive depreciation on properties, and I'll talk about here in just a moment, and then use that to offset your W-2 income or your other types of active income. Okay, now you're not going to get your SECA or your FICA tax back, but you could wipe out all of your other ordinary income tax. Most of the time, now there are other ways, but one of the ways when we're talking about purchasing turnkey rentals would be through what they call cost segregation. Now, one thing that was put into place here a few years ago under the Tax Cut and Jobs Act under President Trump was the ability to be able to break down certain elements of a property into smaller components. And then those certain components can be depreciated immediately or in year 1 when the property is in service. And so let's walk through an active.
So with that, like you're accelerating the depreciation.
You're accelerating depreciation. So
say
for example,
you're not going to get it twice. You're accelerating a portion of the depreciation that you could collect normally over what is that 27?
27 single family rentals are 27 and a half years.
Okay.
So normally when you go and you buy a property, okay. So say for example, let's use some round numbers here. You go and you purchase a property for $200,000. Mm-hmm. Part of that $200,000 you're going to have to apportion to land. Mm-hmm. So let's say that number is 20%. Mm-hmm. Okay, I'm going to see how good I can do math. I can do math here in my head. So yeah, I got that. So 20% of the 400,000.
20%. You said
20. So 20% is land.
That's 40,000.
That's 40,000. Mm-hmm. That cannot be depreciated. So I take the remaining 160. Now we can take that remaining $160,000 normally without accelerated depreciation. That $160,000 would be depreciated over 27 and a half years. Now if I go through and have a cost segregation report done, then that $160,000 will be broken into a number of different components. You'll still have a portion, the largest portion, maybe say 60% of it, will still be depreciated over 27 and a half years. But the remaining amount of it can be accelerated, which would be land improvements, would be any sort of what's considered furniture and fixtures within the property, certain components within the property. Generally, it's anything from the drywall in that can be accelerated. And so when the study is done, then you're going to take usually it's about 40% of that remaining amount, okay, and you would be able to at that point, it's usually 30 to 40%, and immediately expense it through depreciation in year 1.
So when you say depreciation, I want to get on this. What is it actually? Like when you depreciate something on your taxes, mm-hmm. What's the tax effect?
So when you depreciate something, the first thing it's going to do is going to offset any income any other net income you have on that particular property. So if you had $10,000 in rent that you collected that particular year, you had $2,000 in other expenses, $8,000, and then you have say $15,000 in depreciation. Okay, the first portion of it, the first 7, 8, whatever. So the first $8,000 is going to be wiped out, and then the remaining $7,000 would be used to offset against other income.
So you buy what you said, $200,000 property. You depreciate it all the way down for 27 and a half years, right? And then what happens?
Okay, so at that point, you still have the remaining $40,000 that you haven't depreciated. That's the land. Now, in theory, okay, usually by then you're at the point to where you may be retiring, something to that effect. So you don't have other sources of income. Your income tax rate generally is going to be lower. So it is a good time to have more taxable income at that point. Because generally you are at a lower tax bracket. Now, there are other things to be done. You can do a 1031 exchange. You can do other types of things to maybe step up into another property.
Once you're done depreciating 27.5, you don't get that depreciation anymore. It's over.
Correct. So
now you don't get that. You don't get that benefit anymore.
Correct.
But so then I guess the other thing is like, so what if I want to sell it then? So if it's 30 years, like I bought a house in my 30s and now I'm in my 60s. Mm-hmm. And I paid $200,000 for the house. At this point, I mean, even at a 2% appreciation rate, which is probably low over like the course of 100 years, mm-hmm. But at 2%, I mean, that property at that point may be worth say $320, $350 mm-hmm. At that point. what happens then when they go to sell the properties for, let's just say they sell for $350?
Okay, so under current under current tax rules, at that point, if you were to go and sell it, so let's just keep the numbers easy, 300,000. So you sell that property for 300,000. You have $40,000 in your remaining basis, which is the land that you haven't used. So that remaining, my math is correct, $260,000. You're going to pay a long-term capital gains rate on it.
So you're capturing back now. Like all that income that you got to say was not income over the period of time is now new income. I just want everybody to understand that. Like depreciation is not really like it's tax free. It's not the fact that I never have to pay tax on it. It's just like some like magic thing that the government gave me. And actually, if you ask me, the reason why the government gives us depreciation is because that they know the expectation of appreciation for a lot of the things that they give depreciation on. So they know that there's an expectation that things are going to go up in value, and when they go up in value, at some point you're going to sell in the future, and now you're going to have to pay tax on a larger amount. Does that make sense? I was thinking about this today, like as we were going into this. I just, to me, I don't think most people think about that whole process. Now at that point, now this is why 1031 becomes advantageous at this point, right? Because like it's not just the 160. Now we're talking 260. You know, it's a lot more money. And even if you only sell in say 10 years, there might be $100,000 in equity. Like that's how much tax would a normal professional making $200,000-$300,000 a year expect to pay in tax, Josh, on that $100,000 new capital gain is what end up being considered, right?
Right. Well, in 2021, still, the capital gains rate is capped at 20%. So you'd be paying 20%. Now, the depreciation recapture is taxed at 25%. So it is taxed a little bit higher. So you kind of have to be aware of that. If you if you're not planning on holding the property, and generally if you're doing a cost segregation, we're going to say you need to hold on to that property 3 to 5 years for it to make sense. Otherwise, it's pointless to do it because of the depreciation recapture.
And cost seg gets really complicated. Yeah. Most of our turnkey buyers don't take advantage of it. And honestly, like for me, I don't even worry about it because I feel like at the end of the day, if I do go to sell at some point, I'm going to have to pay it back anyways. So it doesn't really matter. So it really depends on where you're at. If you're a professional and maybe the next 2 or 3 years, you're going to make an extra $200,000 or $300,000. I have friends of mine that they're at Belk. So they're looking for anything they can possibly use to offset income the next 2 or 3 years. If you're in that situation, then cost segregation may absolutely be a benefit to you, right?
Sure.
So let's just get in quickly to 1031. We don't have a whole lot more time on the podcast, but just kind of explain 1031, what's required, and how can people take advantage of that, and like what does that mean in the whole tax world?
Okay, so 1031 exchange, and of course there is an attack on this going on right now. And
well, the other thing we didn't talk about too when it comes to depreciation is the stepped up basis. So like, you want to explain stepped up basis right now real quick, or you want me to?
No, go ahead.
Josh is here to confirm if I'm right or wrong, right? So stepped up basis basically means like, let's just say I own the property for 30 years and I depreciate it all the way down. And then I die, right? Inevitably, like two things that we know are going to happen, death and taxes, right? So I die and I give these properties, they have to go somewhere, but my heirs, doesn't matter if it's my kids, doesn't matter if I'm giving them to Josh or Jared or Ben or anybody, whoever I give them to, like they now get a brand new stepped up basis, which from what my understanding is, Josh, is like the new market value. So if the new market value is $300,000 on the scenario that we gave, they get to start depreciating all over again at $300,000.
Right, so they get the stepped-up basis, which is that fair market value as of the date of death or 6 months after, which is called the alternative valuation date. Yeah.
So that again, like that's a whole brand new benefit. That is like one of these secret sauces of generational wealth when it comes to passing on property, because they get a whole brand new stepped-up basis and a whole brand new $300,000 to depreciate over the next 27 and a half years. Now, there is some limitations beyond that. I don't believe you can redo that again, but that's probably a bit more complicated question. If Josh wants to get in that, you can or not. But 1031, so let's just say I own the property for 10, 20 years, Josh, and I sell it and I don't want to pay this massive tax. What options do I have?
So a 1031 exchange basically is allowing for, instead of you paying capital gains tax when you sell the property, for you to be able to purchase, it has to be a like-kind property. So single-family rental for single-family rental, commercial property for commercial property, land for land, et cetera, okay? So it has to be a like-kind property. And then, so you would exchange it, essentially the one type. So say, for example, a single-family rental that you may have owned for a number of years, and you have to have owned it for at least 1 year for it to be long-term capital gains at that point. and then you can essentially take the remaining basis and reduce the new property amount by that remaining basis. So you're just essentially rolling your basis into the new property. You're not paying capital gains on it.
So how does that work? So from my understanding, if I'm going to do this, I have to know about it before I sell the property, right? So there's a lot of people that they come to me.
Timelines.
They come to me and they're like, I just sold the property. I just closed yesterday, or like just closed last week. I want to do a 1031, and I'm like, it's too late. It's over. Like your opportunity's over. So. Can you quickly walk us through that, Josh? Like, so you have to get yourself an attorney, or is it just an attorney?
No, it's qualified. It's called a qualified intermediary. And attorneys are not QIs. Accountants are not QIs. They don't allow for us to do them anymore. So you'd have to contact a qualified intermediary. We have quite a few of them at our firm that we utilize depending on what you have going on. Then at that point, you have to identify within 45 days of the closing. So you have to make a determination. So say, for example, you own this property.
Within 45 days before you close.
Let me walk through this. Okay. So you've gone through and you have made a determination that you're going to want to do a 1031. Okay. So you cannot go and close and take the money. You have to get a qualified intermediary involved before closing. They're going to take hold of the funds. They have a fiduciary responsibility to hold on to it and put it into trust for you. Okay. So the QI holds onto the funds. You have 45 days after the close to identify a property. After you close on the property,
it's 45 days now. I thought it was 60.
Then you have 6 months to close on it.
Okay, so let's just walk through that timeline. So before you close, you already have to have this intermediary set up. They have to agree. There's a fee for this too, just so you guys know. This isn't free. People don't do it for free. And Josh, like, how much do those normally cost? Is it kind of based on like how big the property is, how much money they're holding on to, like?
Yeah, all those elements. And usually the cheapest is going to be $1,000, and it goes up from there.
Okay, I mean, I've seen even on single families, the cheapest I've ever seen is $5,000 or $6,000. So I'm glad he said that there's even those people out there who will do them for $1,000, because I didn't realize that.
Good luck finding one, but I mean,
yeah, I was like, I haven't seen anybody for less than $5,000 or $6,000.
Yeah.
And because it's funny, because a lot of times even like our turnkey buyers are selling a property maybe, and they're going to make $30,000, and I'm like, if you're going to pay $6,000 for an intermediary, it's almost not worth it, because the amount of tax you're going to save is like almost the same amount of money. So
yeah, so if you're talking an $80,000 property, it makes absolutely no sense to do it.
Right. So you have to know how much money you're making. So how much money you're actually going to have to pay back. Now, it doesn't even matter about how much. If it's an $80,000 property, but it's already been depreciated down to zero, well, it might make sense at that point. But it's not going to make sense if they bought it for 70 or 60 or 50 even. Like, so my rule of thumb, whether it's worth it or not, I want to be making $50,000 or more to even consider it. Like, to me, I just don't think it's worth it. But that's just my opinion. That's not like, black and white. So then you have to find somebody ahead of time. You're going to have to pay them. They're going to take the funds at closing. And then, like Josh said, you have 45 days to find property. And then you have 6 months to close. I think there's actually timelines beyond that if you're going to do repairs to the property. And the money that you have held in trust there can be used for repairs as well. And then I think there's a couple more rules, right, Josh? In my understanding, there has to be you have to do at least the amount of money that you have, or is it the amount of property you sold?
It needs to be essentially the capital gains plus your basis needs to be rolled into the new property.
Okay, yeah. So if it's a $100,000 house that I just sold, I got to buy another $100,000 house or more.
Right.
Now I can buy more.
Right.
Mm-hmm. And I can even use that big chunk to like buy, more properties, correct? As long as they're like kind, and I can leverage if I want to, right? So all these things kind of go into play, and all you're doing. So one thing I want to clarify, because I'm not understanding this now. You said it rolls into your new basis. Does that mean the basis that you start with on the new properties is now lowered?
It's now lowered.
Okay, so that's something that I didn't really completely understand until this podcast. So I'm glad that we clarified that. So let's just say I buy a $200,000 property, and I have this $100,000 chunk from the first deal I did that was all gain. Let's just say it's all gain. I'm not sure. It probably couldn't have been, but let's just say it was. Now my new basis that I can depreciate in the second property is only going to be $100,000.
That's correct. Right.
If I do 100 for 100, I'm not going to have any basis.
Correct.
I'm not going to have any more future depreciation. It's just like I took the cash and I moved it to another property and I just didn't have to pay tax now. It's just going to be prolonged, and at some point down in the future, the government's thinking, I'm going to get paid on this, right? Mm-hmm. All right. Can you continue doing that? Can you continue, like time and time again? Let's just say I do this 5 or 6 times in my lifetime. I can continue to 1031 over and over and over again, correct?
Yeah, as long as you continue to have basis there to to roll into.
I remember Greg Bond in our mastermind. He wanted to explain this to like really young. If you can do this when you're 19, like buy your house and then like go to a duplex and then go to a fourplex, and like by the time you're 60 years old, you're gonna have a big multi-unit and it'll be all paid in full. And anyway, so
well, that kind of goes into question because Josh, you did say you buy one property and you buy the same one in kind. So if I do this with a single family, do I then have to roll it into a single family? Or
right,
is
so
it
can be, and there are kind of ways around this. We talk about DSTs, and it can get really, really complicated. But generally, when we're talking about most people when they're thinking about doing a like-kind exchange, yes, you can trade. So when we talk about, when I'm saying single family, when we talk about like-kind, it has to be the same depreciation kind with the IRS, which is 27 and a half years for 27 and a half years. That can be up to an 8-unit if it's not considered commercial. Once you start getting larger than that, so it can be a multifamily, but it's still considered depreciated over 27 and a half years. So when you were talking about, the gentleman that was in our mastermind, that's kind of the way you go through. But to the point you can't go from an 8-unit to buy an apartment complex or a hotel or a storage facility, those types of things. That's not a like-kind exchange. But you can kind of ramp up from a single family up to maybe an 8-unit at that point using this particular strategy.
Awesome. So we've gotten through most of the basics. And I know that this is a little longer podcast, but we're just going to keep going. We're in 2021 and everything's crazy. So we just decided, hey, there's got to be some tax updates, Josh. If there's anything that you can want to throw at us this year that might be different than years past.
Yeah, we've talked about 1031s, and I actually kind of typed out these notes because this is like really hot and heavy. And some of these have changed. I actually did a podcast on my platform regarding to some of the things that President Biden was wanting to do, or whoever's the puppet is in President Biden's back.
We're not going political, folks.
Yeah. So it's kind of one of those things that, of course, he's aggressively, kind of this whole mentality that people who make money are bad, and their money needs to be taken away from them and given to people that don't work. So it irritates me as an entrepreneur, and I got into politics at night. Okay.
It was kind of coming.
I understand.
It was
I agree. I concur.
So I promise you, most of the time your producers are, they're going to be in opposition to a lot of this. But when we talk about the 1031 exchanges, at this point he's not looking to eliminate them. He's just simply going to say that either you can't use them depending on your income level, or you're going to be taxed at an ordinary income tax rate. So he's doing eliminate 1031 exchanges for those with income over $400,000 a year. He has his $400,000 threshold that he keeps talking about. So if you're over that threshold, then you would not be able to utilize 1031s if indeed one of these three different, one of these laws go through, or bills go through that he's put out there. So you just kind of be aware of that. If you're a little bit of a higher income, $400,000 is not that much money anymore. It's going to affect more and more people. So if you're at the $400,000 level, you're going to have to be aware that that there's going to kind of be this target on your back that's going to come after you. So you're not going to be able to utilize 1031s. If your income is over $1 million in income, you're not going to be able to pay the lower capital gains rate. You're going to get hit with the ordinary income tax rate plus the net investment tax. So essentially, you're looking at about a 44% tax hit, and that's not counting your state rate on the capital gains side if you're over $1 million in income.
And that's for what? When you sell a property?
Right.
That's
So when you go
gains.
through
So that's not
any sort of
1031.
capital, that's not 1031. So anything capital gains related. But if you're over the $400,000, you're not going to be able to utilize the 1031.
Right.
So that's going to affect a lot of people who have the ability out there to be able to do what we're talking about.
I know. So, but the whole purpose that you said that the reason why these things are there in the first place is because they wanted to ignite investment. They wanted people to make these investments. So basically, what you're saying is at this point, what that's the net effect, or what they're trying to do is to stop this investment.
Sure. I don't think they're thinking that far out.
Well, I don't either, but I'm just saying, if you use the logic from this is why the government has this in the first place, then if they stop doing this, then they're really what they're doing in essence is stopping, the enticement or that nugget that you get for investment.
I hate to say it. It is kind of one of those things. You're the progressive left-hand side of that particular party. They're not thinking 2 and 3 steps ahead. They're trying to silo this and say, okay, well, if we do this, we're going to raise this amount of money and be able to invest it in infrastructure
And get this money votes.
And you have to remember that for people like us, who are the producers, guess what we're going to do? We're going to hire less people. We're not going to buy that property.
You got it.
We're going to find other ways because guess what? The government is going to force us to act in a way that they want us to act. And that does not mean they're going to force us to pay more in taxes always. Okay, it may mean I'm going to utilize some of the other strategies that are still out there.
Yeah.
It may be personal property investing. It may be doing other types of things that we're going to end up investing in, because now the government is punishing us now for really, we talk about infrastructure spending. What's better infrastructure spending than an investor going through, taking a property that's in disrepair, fixing it up, and then allowing for somebody in the community to live in that home.
Yeah. Or commercial, or whatever it is.
Whatever it
right?
is.
It
And I mean,
doesn't
that's
matter.
just kind of like, okay, this is the foundation. We talk about, the American dream. What's one part of the American dream? Owning a home. Just on Facebook today, one of our friends that we know well put on Facebook, bought my first home today. And I applaud that as part of the American dream. They went through and what are you guys doing as real estate investors? You're providing for part of that. Well, guess what? You punish that activity, you're going to see more and more boarded up houses. You're not going to see investment going into that community. And who cares if the roads are paved? Nobody's living there anyway.
Right. You got it. So what else in 2021? So basically none of this has happened yet.
Right.
But I also know that there has been, a target on the stepped up basis as well.
There has been, and for most people, at this point, it's not going to affect them. It's going to be more at death. If you have over $1 or $2 million in essentially in what's in assets, essentially they're not excluded, and we get really complicated on here. So if you have $1 million plus net worth,
But that hasn't happened yet.
It
This
has
is
not
just what
happened
they're
yet.
trying to.
right? It's what they're trying to do. In all probability, it's probably going to go through. But it also, in all probability, for most people listening, by the time the next administration gets in, provided we don't continue down this crazy insanity of lack of understanding of the way the capitalism works that's going on now, that the next president that comes in Congress will reverse this and bring a little bit more sanity back to the marketplace.
We can only hope so.
We can only hope so. Yeah.
So anything else in 2021? Anything different that we need to keep our eyes on for real
Not
estate investors?
for real estate investors, no, because there's a lot more that goes on to it. I mean, they're kind of doing a lot more for lower income taxpayers as it relates to some of these other things, and we get to that on a different podcast. But for now, as far as for the real estate investor, just be kind of aware of those things. Keep your eyes open. If and this is a year, if you're looking to do something, the rules have not changed yet, and most of this will not go into effect until 2022. So if you're going to do something, act quickly, get it done now. Whether it is a 1031, if you're looking to buy properties to take advantage of the accelerated depreciation, it does not look like they're going to change that as of right now, but they may. But those are things. I mean, this is the year to make things happen, where we know that, at least as of right now, what we're definitively looking at. And one thing that I think we all do understand is that those rates are going to go up, and some of those benefits that are in place now are going to be taken away.
Absolutely. So thank you so much, Josh, for being on today. Appreciate your time. Thank you for your investment in our community. If somebody would want to get a hold of you, do you have a website or a place to be able to send them?
Sure. So the name of my firm is Lodestar Tax and Consulting, lodestar.tax, LODSTAR .tax, and we have a web page. You can find us on Facebook, LinkedIn. We're there.
And you do specialize in real estate investors. So just so you guys know, there's not very many accountants out there that are really specialized in this space, and some of them that do have no idea what they're doing. But really, like your typical accountant, like this has gotten so complex over the last 20 years that you don't even try using a regular accountant when it comes to your real estate stuff and your real estate thing specifically.